Hey guys, just last week I was on BBC News as being one of the recipients of the CBILS scheme. This is a coronavirus business interruption loan scheme. We were one of, I think, 0.3% or 1% of businesses that got access to this loan scheme, which is a zero interest loan backed 80% by the government. A lot of people have been messaging me asking me how we got the scheme and what's important to getting it. So what I want to do in this video is do a quick crash course in how to do a cash flow forecast. I'm not an accountant, but I have been running a tough business for 20 years. My industry is capital intensive, cash flow management's really hard, but I've still managed to build up a multi-million-pound company and an even bigger property portfolio. And I would say one of the key things to being able to do that is speak the language of financiers and be able to do an accurate cash flow forecast. So I'm going to talk you guys through this in this video. I'm sure accountants will probably rip me to shreds for the things I'm going to say and correct me, which is totally fine. This is just what I've done in my career, sharing the knowledge with you guys and making the templates available for you as well. I'd encourage any accountants to correct me on this or even do their own videos that make it more accurate. But this is the crash course guide for doing a cash flow forecast for your business from someone who's a business person but not an accountant. So let's get down to spreadsheeting. So this is Google Sheets, which is a free online spreadsheet program. I'm going to make the link to this spreadsheet available to everyone. In this video, I'm going to do the formulas quite quickly because covering that's a whole other video and you can look on YouTube if you want to know how to do formulas. So, I'm going to make the sheet available so the formulas will be in there for you. Basically though, back to me for a second, hang on, camera. What is a cash flow forecast? It's not a profit and loss account. It's a forecasting document that looks at money in, money out, basically. Very much what you're probably already doing in your business anyway. What money you got coming in, what you got going out, what's left at the end. It kind of loosely represents profit and loss, but it's a slightly different document because of the function it plays. Now, the reason banks are interested in this is they want to see what your predictions of the future are and what your business is going to look like in months to come. It also helps you understand where your pressure points might be. And also where you're at now, which then allows you to model things more accurately. What is your appetite for capital expenditure? Can you take on new staff or not? How liquid are you going to be? Or, you know, in an ideal world, it might even highlight where there might be issues in the future. So let's get down to business on this one. Back to screen share. Yes, cool. Okay, brilliant. Okay, first thing, really simple, income. Income up here. Actually, no, sorry, opening balance. Opening balance. I'm going to keep all the numbers in this video, round numbers, small numbers as well. They don't relate to my business at all, but they're just ones that we're going to work from. So opening balance is basically what you've got in your account now. So let's say you've got £100 in your account now. You then look at your income. What I then recommend doing is breaking the income down into classifications. So I will use my industry as an example here. It might be that you've got rental income. You've got sales of items. You might also have, in my case, conference work. You might have festival work. You might also have awards show, for argument's sake. Just as equally, that could be you're a pub and you've got beer sales, food sales, I don't know, merchandise, car park income, and wedding rentals for your back room of your pub, whatever. It doesn't matter. Break it down to some classification. This is important. Next thing, you can look at your outgoings. Outgoing. So you might have, obviously the big one's going to be probably staff. And then you might have rent and rates. Now, I'm going to break this down. Normally in a P&L account, you would say rent and rates together. But I'm going to talk about later why I'm breaking this down to separate rents and rates. This is actually going to be critical to the strategic part of this video I'm going to do later on. So outgoing, staff, rent, rates. What else have we got? Let's say insurance. Let's call it stat insurance. So public liability, employer's liability, and maybe your asset insurance as well. Then let's do vehicle insurance. And again, there'll be a reason why. I'm going to show you later why I'm breaking these down. Vehicle insurance, let's say internet, any subscriptions. Maybe you've got an outsourced HR function or similar. What other outgoings does a business have? Let's think about that. Electricity. And that'll do for now. Do it for your business. You know your company. You know what's going out, but write it down as accurately as you can and try and be very granular. It doesn't matter if that rolls on more and more pages. That's totally fine. I'm just keeping this simple so I can try and keep this video less than 10 minutes. Good luck with that one, Johnny. Right, income, outgoing. So let's say your opening balance was 100 quid. Then your income, and this is monthly, by the way. So let's do our months. What are we now? We're in May 2020. I'm going to populate this list. Again, I'm not going to teach everyone here how to do spreadsheet work because you can read elsewhere on that. Hang on, bear with me. That didn't work. May, June 2020. I do think it's not a bad thing to see how quick you can get when you've done quite a few of these kind of things. So income, let's say rental income's 50 quid, and I hope it would be more than that. My business, sale items, you might only have a 10 quid of that. Conference work, 80, festival work, 50, and then awards, 35, yeah? Okay, we're now going to subtotal this so you can see what all your income is. Sum. Google Sheets is great because it auto-populates. Always write in what these things are. You will need it later and you won't remember what all your columns are. So, going to make that underline as well. Okay, outgoing staff. Let's say your staff is 15. Let's say your rent is 5. Your rates are 3. Your stat insurance is 2. Your vehicle insurance is 2. Internet is not much, 1. Subscriptions are 1. And electricity is 1. Those numbers are actually a bit out, aren't they? Let's make them bigger because that's not very helpful. Sorry, guys. Let's make it sort of 60 and 20 and 15 and 10 and 10 and 5 and 5 and 5. Okay, now let's do subtotal again. In fact, if these numbers are wildly out, that wouldn't necessarily be a bad thing later. So, got opening balance. So, if you think of this as your bank account, you got your opening balance of 100 quid. You want to add all of your income and subtract all your outgoings. Pretty simple. So that will then, so I'm going to do this here, equals opening balance plus income minus outgoings. Your closing balance is now 195. Closing balance. See? Let's underline and bold that. That's an important number. Okay, now what we can do is we can populate this across to October 2021. What I've just done then is replicated all the numbers across, okay? Now your closing balance of May is £195. Therefore, the opening balance of June is 195, i.e. what was in your account at the very end of May is going to be the same as the very 1st of June, like a minute later when it gets to June. So you're going to equals that. And then we're going to do, this should work. Yeah, it will actually, across to there. Hang on, not quite actually, my apologies. Yeah, I need to do this as well. Okay. Now, what I'm doing all the while I'm doing is I'm fact checking just to sort of quickly check to make sure these numbers are right. Because, like I said, I'm no accountant, so I like to just check my numbers and make sure it looks about right. Okay. Income, outgoing. So let's actually also write here cash generated as well. There's another formula which would be useful. That's basically how much extra cash you built that month. So income, take, outgoings. 95. Sounds about right, yeah? Okay, cool. So looking at this, here's all your income, there's your outgoings, and that's where you're going to be at the end of the month. Looking pretty good. Every month, you're building up your cash reserves by a bit, which is looking pretty good. I mean, that might be how a really good company works year round. But it's overly simplistic, and this is where cash flow forecasts can go wrong if you oversimplify things. A bank manager or financier or investor would look at that and say, whoa, guys, come on. You're not going to buy any equipment. You're not thinking any one-off staff costs. You're not thinking about things breaking. You're not thinking about maybe a bit of work goes wrong or maybe some clients default. It's like, come on, guys. This isn't actually a credible cash flow forecast and doesn't represent the real world. So let's put in here an allowance for new equipment. No matter what your business is, a pub or an events company like mine, you're going to need some new gear at some point. So what you might do is be really accurate and stick different amounts in each month, 10 that month, 15 that month, and so on. Whatever, yeah? Or you might think, you know what? Generally speaking, the amount of money I spend on new equipment is going to have some relevance to the revenue that I have. So in my case, which is one of the things that makes my industry hard, is I would say that there's a percentage of my turnover that's spent on equipment. So I do my turnover, and let's say it's times 10%. That's what it used to be back in the old days. Times 0.1. Okay, cool. Okay, so new equipment is 10% of my turnover, okay? Now let's make sure that's factored into the subtotal. Going to change that to 21. Again, you don't need to know the formulas of what I'm doing here. The point I'm making, though, is make sure the stuff's in here that needs to be in here. The other thing you might forget, and this is something a lot of people are guilty of, is what about the director's salaries? I'm assuming that most people are probably paying themselves significantly in dividends, and it's not within their staffing cost. So let's also make sure that goes in there too. So let's add a row here for direct to pay through whatever means. And let's say that's 5 a month. Again, we're just going for random round numbers here, okay? I'm not suggesting this is your business or mine or any business for that matter. So direct to pay, what else should be in there? What kind of money do you spend in there? Is the percentage of 10% of turnover accurate for new equipment? Maybe it is, maybe it is. You've got to ask these questions, be critical of yourself. Okay, next thing. Now you might be paying your staff $60 a month, but in the UK we have national insurance, employers' national insurance, employers and employees' national insurance, and PAYE. So let's make sure that's listed. Now, even if that number you put in there included that, still write it as a second line, because a lot of this is about credibility. If you don't have the credibility, because things aren't listed, people are going to chuck it in the bin straight away. So PAYE and NI. So you need to look at your own payroll data, but UK income taxes 20%-ish, national insurance is 9%, 11%. Again, I'm not an accountant, look at your own accounts, but generally speaking, you could broadly say it's between 35 and 40% of staff costs. Again, check your own numbers. I'm not interested in debates on taxation, just talking very broadly here, okay? But you guys are a good bunch, so I'm sure you're not going to start criticizing because Johnny got the tax rate wrong. Again, I'm not giving tax advice. So let's say it's 35% for argument's sake. Again, it depends on what your staff earn because income changes at different levels. Right, suddenly things start looking a bit different here. That number's dropped a lot, your closing balance at the end of the year. What else could we include in this, which if it's not there, is going to lose you credibility? Okay, have you considered premises maintenance? You might be on a full repairing and insuring lease. That's where you're obliged to look after the property you're in. So let's make sure that goes in there. Again, to not have that, if I was investing in your company, I'd be like, guys, you seriously telling me there's zero maintenance on your property? Come on. So let's do that. Building repairs. The reason I'm going in this order is I wanted you to initially look at that and kind of clench up a bit, think, geez, man, you haven't put all your outgoings in there. I want you to think like that. Be critical and be analytical and scrutinize what you're saying. Otherwise, you're going to lose all your credibility. And that's not just bad for one application for additional finance. It's going to lose credibility in the relationship, and you want to avoid that situation. So let's say your building repairs are 2 per month, okay? Okay, put that across the period. Okay, we've now dropped down a lot, down to 900. This number's getting lower. You get the idea. I'm not going to start making up more costs, but broadly, that's probably a pretty good start. So this is where your forecast is. Now, let's say you're an industry where the coronavirus is going to hit it hard. I'm in live events, and I use a pub example. Your revenue is probably going to drop pretty significantly. So this is where things get tough. You've got to start making some estimates on how your revenue is going to drop, and you've got to be able to justify it. Maybe you could apply a percentage discount. Maybe you could go through month by month, and you could start hacking up the numbers. Maybe you could even list your specific clients and what they're going to be spending with you in the next 6 to 18 months. On a personal level, that's what we did with our company. We have multi-year contracts with our clients. We've got a very good visibility on what the expenditure is on them. We also know the risk profile of, for whatever reason, those clients not continuing or those projects not happening. So I modeled all of that. Again, I'm keeping this relatively simple. So let's say that there's some public data saying that your sector is going to suffer a 30% drop in income. Let's now put a percentage discount to your income here. Let's call it discount to due to virus. Now, if you could find some empirical government data saying we think that the pub industry is going to drop by 30%, that's really useful because that's the best data source you're going to get right now, okay? So let's go equals that times 0.7, which equals a 30% reduction. Again, if you're interested, if that doesn't make any sense, just email me. I'll quickly amend this for you. It's fine. Let's put that across here. And let's just change that as well to discounted due to virus. Okay. And let's make that the new underline bit. And let's call this the normal subtotal. So you see I've started with a pretty simple, very like A-level standard cash flow forecast. And it's starting to get a little bit more complicated now. So closing balance, we have to change that to B11, which is now going to represent what's really going on. Okay, see over here now, this is now dropped to 833. We're just going to do a quick fact check on that. Discount there, yes. Just do a quick spot check somewhere else. Again, if I was an accountant doing this every day, I wouldn't need to, but it's just me. So let's just quickly check along, look for a few numbers here and there and make sure they represent what should be going on. Okay, this number's dropping pretty quick. Now let's say that maybe it's going to drop by 50%, your turnover. Going to do that. Okay. Just checking that. Yeah. Okay, cool. We're now at 788. Okay. Let's maybe hit that even harder, actually. Just checking a few numbers here. So that's gone to 32. Why has it dropped so much? I think we've got an error here somewhere. Yeah. Again, I'm being very honest here on my skills and showing you the process I go through, because I would recommend that you guys do this yourselves rather than go to your accountant. 32, excess 46, 32, 100. Doesn't look right. So opening's 100. Closing balance should be that. Plus our income. Yep. Minus our outgoings. Yep. And then this one here. Right. I did make a mistake there. See what I did there? This number didn't look right to me. What I've done wrong is that I haven't changed the which cell is based on the old one without the discount. Again, get that wrong, you lose credibility. You notice my tone slowed down there a little bit. I was like, hang on a second, something's not quite right here. That's what you should be doing. Scrutinize your work. Okay, now we realize that with a 50% reduction in your work, things ain't looking so good. We're now at minus 1,124 for the period. Not a good situation. Doesn't look good. However, it does justify need for a loan, which is kind of the story that you want to, or prediction forecast, you want to present to this situation. Again, you've got to balance it being honest, having credibility, but you also need to outline that there is probably a need here, but also hopefully you're in a situation where it's not so bad that without it, you're out of business, okay? So let's now play the model a little bit. Let's just see if we only suffered a 30% drop in revenue, which means we'd multiply that by 0.07. We run it across here. Okay, minus 314. Okay, this is based on a 30% drop in your income. Okay, so that doesn't look so good. Now let's look at how we could reduce our costs. So presumably, if you're doing 30% less work, your staffing needs might be lower. And it might be that you use some freelance staff, or you use some outsourced labor, or maybe staff are earning overtime compared to usual times. That's up for you to look at from an HR point of view. I'm not going to comment on that in this video. But you might say, you know what, actually, we're seeing a 30% reductions in our work. We can probably say there's going to be a reduction in our staffing costs. So let's put that at 45 a month. Now let's roll that across the whole period. Okay, now we're okay. We've got 50 closing balance at the end of it. Pretty thin. You're obviously ending up a lot less better off than you started with, but it gives you an indication. So would a bank lend you money? They'd see a viable business, but they'd also see that you might need cash, you might not. So the point is, at this point, you've got to be credible in what you're doing. What I did with my business, to be honest, was I modeled various scenarios. What if the work dries up fully? What is our runway? We could survive for a period of about 12 months, let's say, with zero work. But that would also require some pretty harsh reductions in our overhead, which are not necessarily comfortable or good things to do for the business long term. Then we looked at other things like, what if everything happens as we think it will? Okay, that's great. We're totally fine. We don't adjust anything. So it's good to maybe model different scenarios and be clear in your own mind as to how things are going to get done. Now, if your business is looking like it's going to have a tough time, let's take the pub industry. I keep saying these guys because I think it's going to be really difficult for them. And let's say they're... staffing costs can't reduce that much. They're at 50 a month. And let's say their work's going to drop by 50%, their income by 50%. Let's look at that. We're now at minus 881 for the period. So that looks pretty bad. Oh, just to be clear as well, just to caveat this, I haven't put in cost of sales. So as a pub, that's not in there. Again, I've kept this very simple. So next thing you got to do is go through your outgoings and start being brutal on where you can start cutting things out. Now, can you take a pay reduction for yourself? Maybe you can, maybe you can't. So you might want to adjust that and see how your numbers go from minus 879 to minus 845. You might have a chat with your landlord or your pub company and do a rent negotiation. In the case of me, I own my own premises, so rent wasn't a factor. But for my tenants, that might be, so there might be a conversation we had at some point. So let's say you managed to achieve a 50% reduction in rent. Okay, we drop down to minus 665. Building repairs. You might think, okay, let's keep it to the really essential stuff and put that to 1 a month. Okay, stat insurance, right. Now, speak to your insurer, but you might find that given that you're doing a lot less business, which means a lot less risk for the insurer, there might be a conversation we had that you can say, look, guys, the risk you're insuring is very different now because we're doing, in this case, half as much work. So maybe we can reduce our statutory insurance. Maybe have the conversation. So let's drop down to 5. That might be a bit wishful thinking, but this is just modeling at this stage. Okay, we're down at minus 557 now. Vehicle insurance. Let's say you had 10 vans doing local deliveries of beer or whatever. Now you're only running 3 vans. You might say, guys, not as much risk here. Can we knock this down? Maybe you could drop that down as well. Again, have a chat with the suppliers. We're down at minus 431 now. Subscriptions, you might say, you know what, that magazine subscription or that online marketing or SEO subscription, going to get rid of the lot, just going to keep a little bit of really essential stuff to our business. Drop that down to a 1. Let's spread that across the period as well. We're down at minus 359 now. Electricity, well, you're going to be using less electricity. How much less? Who knows? But you might be really disciplined on making sure you turn stuff off when you don't need it. You might not run 3 freezers, you might run 1, whatever. Let's drop that down to 3 as well. Spread that across. Now we're at minus 323. New equipment. You might also say, well, we don't need any new equipment. Or you might say, yeah, I know there's a few specific investments that need to be made in that period. So let's break this one down. So to say to your bank, I'm not buying any equipment, they might say, well, I know you need to buy some, so that's not viable. You might say, well, I'm going to allocate 5% of my turnover to equipment. A bank or investor like me would then say, well, what on specifically? You know, you're talking about borrowing money here. What do you want to spend money on? So then what you might do is go along and say, well, I know in July, the fridge in my pub, or in my case, some speakers need to be replaced, whatever. So you might put a 2 there, and you might add a note to it saying, how do you do a note in this? Hang on. Comment. You might say, whatever, new fridges, whatever. And you'll go along and you'll be specific in what asset purchases you need to make. Okay, so let's do a 3 there, and a 6 there, and a 8 there. Or it might be you've made a commitment to a supplier who you really value, and it's a watertight contract, and for whatever reason, you don't want to get away from it. So you might want to put down those obligations that you've got in your cash flow forecast too. Now, by doing that, suddenly, we have got a positive closing balance. So some pretty brutal hacks at your outgoings. You've made your cash position positive come the end of the year, which is a good thing. So then you might go to the bank with another scenario. One is, here's if we do nothing. Here's apocalypse situation if it all drives up. Or here's a middle ground proposition where I can do certain things to really hack away at my cost base. But I don't want to do that. I want to keep certain things online. I want to keep the business fresh and vibrant and cool stuff happening. So what I want is X amount of money. So you might say, I actually want to maintain my equipment expenditure because I don't want to undermine, our improvement plans or whatever. And I'm at a minus 323. So you know what, bank, can I borrow 323? Whatever. That's basically the idea of a cash flow forecast. None of it's particularly complicated actually, but I think people freak out because they're like, oh, it's accountant stuff, therefore I can't do it. I say, learn the skills, do the modeling, run it past your accountant if you have one, hopefully you do, or maybe have a quiet chat with your bank manager, say, I'd like to have a look at this, get your thoughts and input. But the main thing you've got to do is be able to have an accurate, credible prediction on what the future is based on past performance, based on statutory information, or based on your own estimates. Just be clear on what the basis of that data is. So here's a cash flow forecast I've made. I'm going to put a link at the bottom of this video for you to look at it so you can download it. So example cash flow forecast. Now, on a broader level, talking about the CBILS, being honest with this, we already had a position where we were buying new premises. Our bank had already approved us for quite a lot of finance. So I appreciate and recognize for us it was probably quite easy. And the CBILS was not critical to the survival of our company. We could have survived anyway, for a period anyway. So it was probably easier for us than it might be for a lot of people. But without a cash flow forecast, you've probably got 0 chance. So do this, speak to your bank manager. If you've got a good business and you're still struggling, look at other options. Look at things like getting investors involved in your company. I've got an appetite for investing in other companies in sectors around my industry. So have a chat with people like me, and there's a lot of people out there like me who want to contribute money or resources or expertise, cash sometimes. The other thing to look at doing is any kind of joint ventures you can do. For example, if you're a pub and there's a local food supplier, maybe you guys could join forces. And also look at potential other ways you can run your business. Again, if you're a pub, what are your other potential revenue streams? Don't think you can keep earning money the way you have done the last 10 years. In the case of my company, we've pivoted into various new areas. Look at my other videos. You'll see what we've done as a company to find new revenue streams for our existing assets. It's an interesting time. There's a lot of opportunities right now. And I think that people who are bold and courageous and creative can do really well from this, but I think you've got to up your skills and you've got to really challenge your assumptions on what your business really is. I hope that was useful. I'm ready for all the accountants to be like, oh, Johnny, you got it all wrong. It's fine. Whatever, bring it on. It's all good. Have a chat with me. And I would encourage people who don't like this form of cash flow forecast to do your own video. Make a better one than mine. Please put it out there. Share your knowledge. Give it away. I hope this is helpful. Feel free to message me and good luck with it. Hopefully see you the other side.